Welcome to today's explainer. Okay, if you've been watching the markets lately, you've probably been completely overwhelmed by all the macro headlines. I mean, between the Federal Reserve holding rates steady and tariff headlines whipping the markets around every other day, it is incredibly noisy out there. But while everyone is distracted by those loud, massive macro events, there are these huge, quiet structural shifts happening right under our noses in the fintech space. The real story isn't the noise. It's the hidden architecture of digital commerce that is literally being rewritten from the ground up.
While the broader market is just so distracted by the noise of Fed rates and tariffs, the true signal is happening quietly in the background. The real money is being made in stealthy, highly calculated infrastructure pivots by major companies. We're talking about heavyweights like Mastercard, Riot Platforms, and Shopify. They are making strategic moves that fundamentally change the plumbing of the internet and digital finance. Honestly, if we want to understand where the economy is actually going, we need to completely tune out the noise and focus on this signal.
So here's our agenda for today's explainer. We're going to dive into three incredible case studies. First, Mastercard's AI agent empire. Second, Riot's AI infrastructure pivot. And third, Shopify's secret bank ambitions. Let's get right into it. Section 1, Mastercard's AI agent empire. Okay, let's dive right into this and look at their Q1 earnings, because they just reminded Wall Street exactly who runs the payments galaxy. $2.7 trillion. I mean, let that staggering number sink in for just a second. That is Mastercard's gross dollar volume processed in a single quarter. It absolutely proves that Visa and Mastercard aren't just some legacy incumbents sitting around waiting to be disrupted. They are the Internet of money. They're the rails that everything runs on, and Mastercard is making it crystal clear they plan to keep it exactly that way.
Let's break down those Q1 numbers. Revenue hit a massive $8.4 billion, which is up 16% year over year. Adjusted earnings per share came in at $4.60, easily beating the consensus. But you know what the real standout is? Value-added services. That segment surged 22%. We're talking about things like AI, fraud tools, and data analytics. It is quietly becoming Mastercard's second massive growth engine. Management clearly knows what this network is worth, which is exactly why they accelerated $4 billion in share buybacks this quarter alone.
Actually, scratch that. There is a quick point of caution we need to call out from the data. While cross-border volume, which, by the way, is the fattest margin line on the card, grew 13% overall, April cross-border travel growth actually decelerated pretty sharply. It went from 8% down to just 2%. This is a potential early read on tariff-related consumer hesitation heading into Q2, so it's for sure something we need to keep a really close eye on.
But the absolute biggest takeaway from CEO Michael Miebach wasn't even the numbers. It was his intense focus on what they're calling agentic commerce. This is a framework where AI assistants automatically authenticate and make purchases entirely on a user's behalf. Just think about it. Your AI assistant booking your flights, ordering your weekly groceries, and auto-renewing your software subscriptions. Mastercard's Agent Pay program is already live in multiple markets. This isn't just some experimental pilot anymore. It's a massive strategic priority.
Which brings us to the ultimate question for the future of digital retail, doesn't it? Who pays when AI does the shopping? Well, the answer, clearly, is that it all still runs on Mastercard rails. They aren't just processing human payments anymore. They are positioning themselves to process the entire agentic internet.
Moving on to Section 2, Riot's AI infrastructure pivot. We're shifting gears here to look at a Bitcoin miner pulling off something completely unexpected in Q1.
This one genuinely has a plot twist that reads like a Hollywood heist movie. Riot completely blew past expectations. Total Q1 revenue hit $167.2 million, just crushing the estimates. But the real headline that matters here is the $33.2 million in data center revenue. This is Riot's first meaningful contribution from their pivot into AI and high-performance computing. And the momentum is incredibly real. AMD literally doubled down by exercising an option to expand its contracted capacity with Riot from 25 megawatts to 50 megawatts.
Riot Platforms CEO Jason Les literally called this exact moment a definitive inflection point. And honestly, when you look at the sheer scale of their transition into high-performance computing and AI infrastructure, you can totally see why.
Now, what's really interesting about this is the math behind how they're actually funding this massive pivot. It is fascinating. In Q1, Riot mined 1,473 Bitcoin, but they sold 3,778 Bitcoin. They liquidated more than twice what they produced, drawing down their treasury reserves at an average price of $76,626 per Bitcoin.
That bold move generated almost $290 million to fund their data center build-out. And to be absolutely clear here, this is not panic selling. No way. It is a highly calculated strategy to swap appreciating digital gold for cash-flowing AI infrastructure. Keep in mind, they still hold over 15,000 Bitcoin worth roughly $1.1 billion. With Bitcoin sitting around 77K and AI compute demand showing zero signs of cooling down, Riot isn't abandoning crypto. They're essentially using their massive crypto treasury as a venture fund to buy into the AI infrastructure boom right before the window closes and every other miner figures out the exact same trade.
Section 3, Shopify's secret bank ambitions. Now we're shifting over to e-commerce, where a massive structural move just happened completely under the radar, without a single press release. And, as we know in finance, the quietest moves are very often the most profound.
So, according to recent reports, Shopify has been quietly securing money transmitter licenses all across the US. They've already landed approvals in 18 states and Puerto Rico, and they have applications pending pretty much everywhere else. Their stated goal to regulators? To serve as a money transmitter and a provider of prepaid access. That is the exact same regulatory lane as Venmo, Cash App, and PayPal.
To understand why this is such a massive deal, we have to look at the legacy flow of money. Right now, when a customer pays a Shopify merchant, that money flows through these incredibly clunky third-party payment processors. Shopify commands over 14% of the entire U.S. e-commerce market share, and they processed hundreds of billions in gross merchandise volume last year, yet they're just letting third parties sit right in the middle of all those transactions.
And this brilliantly illustrates Shopify's new vision, which just rips the middleman out entirely. By securing these licenses, the customer pays, and Shopify holds those funds directly before passing them to the merchant. It is a perfectly streamlined, direct flow of money.
The financial implications of this? Absolutely staggering. By holding funds directly, Shopify captures way more of the margin on every single transaction. They also generate float revenue, meaning they literally earn interest on those massive stored balances while the cash just sits there. And perhaps most importantly, it radically deepens merchant lock-in. It makes the switching costs for a merchant feel like walking away from a mortgage. It's essentially the Amazon payments playbook, but with the distinct advantage that Shopify's merchants actually like them. With upcoming earnings dropping soon, you can bet analysts will be drilling down on exactly how far this ambitious transition goes. This isn't just a fun new feature. It is a complete business model transformation from a software vendor into a literal bank.
Section 4, the next era of commerce. So, what does this whole structural shift actually mean for us, for the focused learner trying to map out the future of digital markets? It means we are entering a totally new era of commerce.
Putting it all together, in a single 24-hour news cycle, we saw Mastercard proving they are building the inevitable rails for AI commerce. We saw Riot cleverly monetizing its massive Bitcoin war chest to win the incredibly lucrative data center race. And we saw Shopify quietly telling regulators it essentially wants to be a bank. The thesis here is crystal clear, folks. The real battle for the future of commerce isn't happening on the front end with flashy apps. It's entirely about owning the underlying plumbing.
Which leaves us with this final completely provocative thought. When the internet of money becomes automated by AI, when data centers are being funded by digital gold, and when every major tech company evolves to hold your money, what happens to the actual banks? Thank you so much for joining me for today's explainer, and I will leave you to think about that.